Hey there, future crypto millionaires, and welcome back to Boni's Life. I'm your host, Boni, and today we're diving into something that's been blowing up my inbox faster than a meme coin during bull season. You've been asking me, Boni, where do I even start with crypto trading? I see people making millions, but I can barely figure out how to buy Bitcoin without accidentally sending it to the wrong address. Well, buckle up, Buttercup, because today we're going from crypto zero to crypto hero. And before you ask, no, this isn't another get rich quick scheme where I tell you to mortgage your house for Dogecoin. This is real talk about real trading, backed by real experts who actually know what they're talking about. We've got insights from Brian Armstrong, the CEO of Coinbase, who's basically the godfather of making crypto accessible to us mere mortals. We'll hear from Jennifer Johnson at Franklin Templeton, who manages more money than most countries' GDP. And we'll get the regulatory perspective from the World Economic Forum's latest crypto discussions at Davos 2025. But first, let me address the elephant in the room. Yes, crypto trading can be incredibly profitable. Yes, some people have made life-changing money. But also, yes, some people have lost their shirts, their pants, and probably their dignity in the process. The difference? Education, strategy, and knowing when to hold them and when to fold them. So grab your favorite beverage, settle in, and let's turn you from someone who thinks HODL is a typo into someone who can navigate the crypto markets like a seasoned pro. Trust me, by the end of this episode, you'll understand why Brian Armstrong from Coinbase says we're still in crypto's infancy and why that's actually fantastic news for beginners like you. All right, let's start with the basics because I know some of you are sitting there thinking crypto trading involves actual physical coins. Spoiler alert, it doesn't, and no, you can't use them in vending machines. Cryptocurrency trading is essentially buying digital assets at one price and selling them at a higher price to make a profit. Think of it like buying vintage Pokemon cards, except these cards exist only in the digital realm, and their value changes faster than a teenager's mood. Now, here's where it gets interesting. Unlike traditional stock markets that close on weekends so traders can pretend to have work-life balance, crypto markets never sleep. They're open 24/7, 365 days a year. This means you could be making money while you're sleeping or losing it while you're dreaming about making money. The irony is not lost on me. But here's the key distinction that trips up most beginners: trading versus investing. Crypto investors are like that friend who bought Bitcoin in 2010 and forgot about it until 2021. They're in it for the long haul, sometimes decades. Crypto traders, on the other hand, are more like day traders on espresso. They're buying and selling within days, hours, or even minutes. Jennifer Johnson from Franklin Templeton puts it perfectly when she talks about how traditional finance has blinded us on to the massive growth in this community. She's right. While traditional investors are still debating whether crypto is real, traders are already making real profits from real price movements. The beauty of crypto trading is that you don't need a finance degree or a trust fund to get started. You just need education, patience, and the ability to not panic when your portfolio looks like a roller coaster designed by someone with serious anger issues. Let me share some insights from the people who actually move markets, not just talk about them on Twitter. At the World Economic Forum in Davos 2025, some of the biggest names in crypto gathered to discuss where this industry is heading, and their insights are pure gold for beginners. Brian Armstrong, the CEO of Coinbase, dropped this truth bomb. Crypto is really in its infancy. I'd say about half of the Fortune 500 has some sort of pilot going in crypto. This is a technology that's going to update the financial system globally, make it faster, cheaper, more efficient. Think about that for a second. If crypto is still in its infancy and half of the biggest companies in the world are already experimenting with it, what does that tell you about the opportunity ahead? It's like being offered a chance to invest in the internet in 1995, except this time you actually know it's going to be huge. But Armstrong also keeps it real about usability. He says we need to make crypto easier to use. Most people don't understand how electricity works, but they can flip on a light switch. I think we need to make it that simple. This is crucial for beginners because it means the industry is actively working to make trading more accessible, not more complicated. Now let's talk regulation, because I know some of you are worried about the government coming for your digital coins. Anthony Scaramucci from Skybridge Capital, who briefly worked in the White House, shared some insider perspective. The Republicans want to pass new regulations on crypto before the end of February 2026, ahead of the conclusion of the congressional term in early 2027. This isn't scary news, it's actually fantastic news for beginners. Clear regulations mean legitimacy, and legitimacy means institutional money flowing in. When institutions start playing, the market becomes more stable and predictable, which is exactly what new traders need. Danelle Dixon from the Stellar Development Foundation brings up something most people miss about crypto: its real-world utility. She mentions how the UNHCR is delivering aid to Ukraine using blockchain technology, and recipients get it in under 3 minutes. That's crazy, but that's what blockchain does, she says. This matters for traders because utility drives long-term value. When you're trading assets that actually solve real problems, you're not just gambling on hype. You're investing in the future of finance. All right, enough theory. Let's get practical. Here's your step-by-step roadmap to start crypto trading without losing your shirt, your sanity, or your spouse's trust. Step 1. Choose your exchange wisely. Your crypto exchange is like your trading headquarters, so choose wisely. The big players are Coinbase, Gemini, eToro, and Kraken. These aren't just random names I pulled out of a hat. They're regulated, established platforms with track records longer than most Hollywood marriages. Coinbase is often recommended for beginners because, as one expert put it, it has a sleek user interface, solid security infrastructure, and a reasonable fee structure that's easy to understand. Translation: it won't confuse you with a million buttons, it won't get hacked easily, and it won't charge you fees that require a mathematics degree to calculate. But here's a pro tip that most beginners miss. Don't just look at the pretty interface. Check the trading volume, the track record over the last 5 to 10 years, and how your assets are stored and protected. You want an exchange that's been through multiple market cycles and survived to tell the tale. Step 2. Verify your identity. Yes, it's necessary. I know, you thought crypto was supposed to be anonymous and rebellious. Well, welcome to 2025, where even rebels need to show ID. You'll need to provide your social security number if you're in the US, an email address, and additional personal information. This isn't the government trying to ruin your fun. It's actually protecting you. Identity verification reduces fraud and ensures your assets are connected to you when you purchase cryptocurrency. Trust me, you'll be grateful for this when you're not trying to explain to customer service why you can't access your account. Step 3. Fund your account. Time to connect your bank account and deposit some fiat currency. Fiat is just a fancy word for government-issued money like US dollars. Yes, the same dollars that crypto enthusiasts love to criticize, but hey, you need them to buy crypto in the first place. The irony is delicious. Start small. I cannot stress this enough. Don't deposit your life savings because you watched a TikTok about someone making millions. Start with an amount you can afford to lose completely. If losing that money would mean eating ramen for a month, it's too much. Step 4. Make your first purchase. Here's where the magic happens. You'll see cryptocurrencies listed with their ticker symbols BTC for Bitcoin, ETH for Ethereum, and hundreds of others with names that sound like they were created by a random word generator. For beginners, start with the big names. Bitcoin and Ethereum aren't just the most well-known. They're also the most liquid, meaning you can buy and sell them easily without affecting the price. It's like the difference between trading Apple stock versus some penny stock that trades 3 times a week. Here's a beginner-friendly strategy. Start with fractional coins. You don't need to buy a whole Bitcoin that costs tens of thousands of dollars. You can buy $50 worth of Bitcoin, which might be 0.0008 BTC or something equally confusing. Don't worry about the decimals. Focus on the dollar amount you're comfortable with. Step 5. Learn to read the market. Now comes the fun part. Learning to read charts without feeling like you're deciphering ancient hieroglyphics. The crypto market moves in cycles: accumulation, markup, distribution, and decline. Understanding these cycles is like having a roadmap for when to buy and when to sell. During accumulation, smart money is quietly buying while everyone else is panicking. During markup, prices rise and everyone starts paying attention. During distribution, smart money is selling while everyone else is buying the hype. During decline, well, you can guess what happens. The key is learning to identify which phase you're in. This takes practice, but here's a shortcut. When your barista starts giving you crypto advice, you're probably in the distribution phase. When crypto is declared dead for the 100th time, you're probably in the accumulation phase. Step 6. Develop your risk management strategy. This is where most beginners fail spectacularly. They get so excited about potential profits that they forget about potential losses. Here's the golden rule that every successful trader follows. Never risk more than 1 to 2% of your capital on a single trade. Let's say you have $1,000 to trade. That means you should never risk more than $10 to $20 on any single trade. I can hear you thinking, but Boni, how am I going to get rich risking $20 at a time? Well, you're going to get rich by not going broke first. Use stop loss orders religiously. A stop loss is like a safety net that automatically sells your position if the price drops to a certain level. It's the difference between losing 10% on a bad trade versus losing 50% because you were too stubborn to admit you were wrong. Now, let's talk about technical analysis, which is basically the art of predicting future price movements by staring at charts until patterns emerge. It sounds like astrology for traders, but it actually works when done correctly. The most important indicators for beginners are moving averages, RSI, MACD, and volume. Don't worry, these aren't as complicated as they sound. Moving averages smooth out price data to show you the overall trend. Think of them as the difference between looking at individual trees versus seeing the whole forest. When the short-term moving average crosses above the long-term moving average, it's often a bullish signal. When it crosses below, it's bearish. The relative strength index, or RSI, tells you when an asset might be overbought or oversold. It's like a speedometer for price movements. When RSI is above 70, the asset might be overbought and due for a pullback. When it's below 30, it might be oversold and due for a bounce. MACD, which stands for Moving Average Convergence Divergence, sounds intimidating, but it's just another way to spot trend changes. When the MACD line crosses above the signal line, it's often a buy signal. When it crosses below, it's a sell signal. Volume is perhaps the most important indicator because it confirms whether a price movement is real or just noise. High volume during a price increase suggests strong buying interest. Low volume during a price increase suggests the move might not last. But here's the thing about technical analysis. It's not magic. It's probability. These indicators don't guarantee what will happen. They just tell you what's more likely to happen based on historical patterns. It's like weather forecasting for financial markets. Here's something most trading courses don't teach you. Market sentiment can override technical analysis faster than you can say Elon Musk tweeted about Dogecoin. Understanding market sentiment is crucial because crypto markets are still heavily influenced by emotions, news, and social media. Danelle Dixon from Stellar makes an excellent point about this. There's not a lot of focus on the actual utility, the velocity of all of the assets, what's actually happening on chain that's really transformational. Most traders get caught up in the hype and forget to look at the fundamentals. Social media platforms like Reddit and Twitter can move crypto prices more than traditional financial news. When a cryptocurrency starts trending on Twitter, you can often see immediate price movements. This creates opportunities for traders who know how to read social sentiment. But be careful. Social media can also create dangerous bubbles. When everyone on Reddit is talking about the same coin, it might be time to be cautious rather than excited. Remember, when everyone is thinking the same thing, no one is thinking very much. Monitor news and events that impact market sentiment. Government regulations, corporate adoptions, technological developments, and even celebrity endorsements can all trigger rapid price movements. The key is staying informed without getting overwhelmed by information overload. Not all trading strategies are created equal, and what works for one person might be a disaster for another. Let's break down the main approaches so you can find what fits your personality and schedule. Day trading is exactly what it sounds like, buying and selling within the same day. It requires constant attention, quick decision-making, and nerves of steel. Day traders often use 15-minute, 1 hour, or 4-hour charts to spot short-term opportunities. The advantage of day trading is that you can potentially make quick profits and you're not exposed to overnight risk. The disadvantage is that it's incredibly stressful, requires significant time commitment, and transaction fees can eat into your profits. Swing trading involves holding positions for several days to weeks, trying to capture larger price movements. It's less stressful than day trading but requires patience and the ability to withstand short-term volatility. Swing traders often use daily charts and focus on technical patterns like support and resistance levels, trend lines, and chart formations. This strategy works well for people who have day jobs and can't monitor the markets constantly. Scalping is for the adrenaline junkies. Scalpers make dozens or even hundreds of trades per day, trying to profit from tiny price movements. They might hold positions for minutes or even seconds. Scalping requires lightning-fast execution, very low fees, and the ability to make quick decisions without second-guessing yourself. It's not for beginners, but it's worth understanding because you'll encounter scalpers in the market. Arbitrage involves buying on one exchange and selling on another to profit from price differences. It sounds easy, but it requires significant capital, fast execution, and deep understanding of exchange mechanics. The beauty of arbitrage is that it's relatively low risk when done correctly. The challenge is that opportunities are often small and disappear quickly as markets become more efficient. Range trading works best in sideways markets where prices bounce between clear support and resistance levels. Range traders buy near support and sell near resistance, profiting from predictable price movements. This strategy requires patience and the ability to identify when a market is truly range-bound versus just pausing before a major move. Let me tell you something that might save your financial life. Risk management isn't just important in crypto trading, it's everything. You can have the best analysis in the world, but without proper risk management, you're just gambling with extra steps. The first rule of risk management is position sizing. Never risk more than 1 to 2% of your total capital on any single trade. This might seem conservative, but it's the difference between surviving long enough to become profitable versus blowing up your account in the first month. Let's do some math. If you have $10,000 to trade and you risk 2% per trade, that's $200 per trade. If you're wrong on a trade and lose that $200, you still have $9,800 left. You can be wrong 49 times in a row and still have money left to trade. That's the power of proper position sizing. Stop losses are your best friend even when they hurt your feelings. A stop loss automatically closes your position when the price moves against you by a predetermined amount. Yes, it's painful to watch a trade hit your stop loss and then immediately reverse in your favor. But it's more painful to watch a small loss become a devastating loss because you were too stubborn to admit you were wrong. Take profit orders are equally important. They automatically close your position when you reach your profit target. This removes emotion from the equation and ensures you actually take profits instead of watching them disappear. Diversification in crypto is different from traditional investing. You don't want to own 50 different cryptocurrencies because many of them move together. Instead, focus on 3 to 5 quality projects that you understand and believe in. The 50-25-25 rule works well for beginners. 50% in established cryptocurrencies like Bitcoin and Ethereum, 25% in promising mid-cap projects, and 25% in higher risk, higher reward, smaller projects. This gives you stability while still allowing for significant upside. Let me save you some money and heartache by sharing the most common mistakes I see beginners make. These aren't just theoretical. These are real mistakes that cost real money. Mistake number 1, FOMO trading. Fear of missing out is the crypto trader's kryptonite. You see a coin pumping 50% in a day and think you need to jump in immediately. By the time you buy, you're often buying at the top from people who got in early and are now taking profits. The cure for FOMO is having a plan and sticking to it. If a trade doesn't meet your criteria, don't take it. There will always be another opportunity. Mistake number 2, revenge trading. You lose money on a trade and immediately try to make it back with a bigger, riskier trade. This is like trying to fix a broken leg by jumping off a higher building. It rarely ends well. When you lose money, take a break, analyze what went wrong, learn from it, and come back with a clear head. Mistake number 3, ignoring fees. Trading fees might seem small, but they add up quickly, especially if you're making frequent trades. A 0.25% fee might not seem like much, but if you're making 100 trades per month, that's 25% of your capital going to fees annually. Always factor fees into your trading strategy. Sometimes the best trade is no trade. Mistake number 4, following hot tips. That guy on Twitter with 50,000 followers who's promising 1,000% gains, he's probably selling you his bags. Do your own research and never invest based on someone else's recommendation without understanding why they're recommending it. Mistake number 5, not keeping records. The IRS considers crypto trading a taxable event and they want their cut. Keep detailed records of every trade, including dates, amounts, and prices. Your future self will thank you when tax season arrives. Before we wrap up, let's talk about where crypto trading is heading, because understanding the future can help you make better decisions today. Brian Armstrong from Coinbase predicts that crypto will reach half of the world in 10 to 15 years. That's massive growth from where we are today. If he's right, we're still in the early stages of a technological revolution. The infrastructure is improving rapidly. Armstrong mentions that random strings of numbers and letters for wallet addresses are being replaced by human-readable names through the Ethereum name service. Eventually, people will use crypto without even knowing it's crypto underneath. Regulation is becoming clearer, which is fantastic news for traders. Clear rules mean institutional money can flow in more easily. which typically leads to more stable and predictable markets. When pension funds and insurance companies start buying crypto, volatility decreases and long-term growth becomes more sustainable. Jennifer Johnson from Franklin Templeton talks about atomic settlements, instant transactions that could replace traditional banking intermediaries. This technology could revolutionize not just trading but the entire financial system. The user experience is getting better. Danelle Dixon emphasizes the importance of privacy and ease of use for mass adoption. As crypto becomes easier to use, more people will start trading, which creates more opportunities for those who get in early. Artificial intelligence and machine learning are starting to play bigger roles in trading. While this might seem intimidating, it actually creates opportunities for human traders who can adapt and use these tools to their advantage. All right, future crypto traders, we've covered a lot of ground today. From understanding what crypto trading actually is to learning from industry experts, from technical analysis to risk management, from common mistakes to future trends, your head might be spinning faster than a Bitcoin price chart during a bull run, but that's normal. Here's what I want you to do after watching this video. First, don't rush into anything. The crypto market will still be here tomorrow, next week, and next year. Take time to absorb this information and do additional research. Second, start with education before you start with money. Read books, watch more videos, join reputable communities, and paper trade before you risk real money. Paper trading means practicing with fake money to test your strategies without financial risk. Third, when you're ready to start with real money, start small. I cannot emphasize this enough. Start with an amount that won't change your life if you lose it completely. You can always add more money later as you gain experience and confidence. Fourth, develop a trading plan and stick to it. Decide in advance what you'll trade, when you'll enter and exit positions, how much you'll risk per trade, and what your goals are. A plan removes emotion from trading decisions. Fifth, keep learning and adapting. The crypto market evolves rapidly, and what works today might not work tomorrow. Stay curious, stay humble, and never stop learning. Remember what Brian Armstrong said. If we can actually inject good financial infrastructure to every country in the world for anybody who has a smartphone, plug them into the global economy, I think it's going to lift billions of people out of poverty. You're not just learning to trade crypto, you're learning to participate in a financial revolution that could change the world. That's pretty exciting, isn't it? But also remember what every expert emphasizes. This technology is still evolving, regulations are still developing, and risks are still significant. Trade responsibly, never invest more than you can afford to lose, and always do your own research. The crypto market doesn't care about your feelings, your bills, or your dreams. It's a cold, calculating machine that rewards preparation and punishes emotion. But for those who approach it with respect, education, and proper risk management, it can also be incredibly rewarding. So there you have it, your comprehensive beginner's guide to crypto trading. You now know more about crypto trading than 90% of people who are already trading. Use that knowledge wisely. If this video helped you understand crypto trading better, smash that like button, subscribe for more financial education content, and ring that notification bell so you don't miss any updates. Share this video with anyone who's been asking you about crypto. Trust me, they'll thank you later. Drop a comment below and let me know, what's your biggest question about crypto trading? What topic should I cover next? I read every comment, and your feedback helps me create better content for this amazing community. Until next time, this is Boni reminding you to trade smart, stay educated, and remember, in crypto, as in life, the only constant is change. Peace out.